Hi. At some point, maybe after seeing someone online claim they turned $500 into $50,000 by buying the right stock at the right time, you looked at your bank account, looked at your rent due date, did some math that didn't add up, and briefly considered whether the stock market might solve the gap. This video exists because that thought is where a lot of financial pain begins, and also where a lot of financial literacy could have begun instead. So let's do the second one. Everything you need to know about how the stock market actually works, what causes crashes, what actually happened with GameStop, and how to not lose your rent money. Let's go. Start with the most basic question: what is a stock? A stock is a unit of ownership in a company. When a company wants to raise money without taking on debt, it can sell pieces of itself to the public. Each piece is a share. Buy one share and you own a tiny fraction of that company. You're entitled to a tiny fraction of its profits if it pays dividends, and you get to vote on certain company decisions in proportion to how many shares you hold. The total market value of all shares combined is called market capitalization, or market cap. A company with 1 billion shares outstanding and a total market value of $50 billion has shares worth $50 each. Market cap is how we compare the size of companies. Small cap, mid cap, large cap. Apple's market cap has crossed $3 trillion. Your university's endowment is probably not competing. Why do companies issue shares in the first place? Because selling equity is cheaper than borrowing. Taking on debt means paying interest every year until you repay it. Selling equity means giving up a slice of ownership permanently, but there is no interest clock running and nothing to repay. The first time a company sells shares to the public is called an initial public offering, or IPO. Investment banks underwrite it, set the initial price, and the shares begin trading. From that point, the company does not set the price. Every buyer and seller interacting in the market sets it. When you buy stock through an app, you are not buying it from the company. You are buying it from another investor who decided to sell. The price you pay is whatever both sides agreed on, and that agreement happens millions of times per second every day the market is open. This continuous process is called price discovery, and it's the market's mechanism for constantly answering the question, what is this company worth right now, given everything everyone currently knows? It is not a perfect answer. It is the market's best guess, updated in real time. When new information arrives, earnings reports, product launches, scandals, interest rate decisions, the guess updates instantly across every affected stock at once. The market processes information faster than any individual could. It also panics, overreacts, and occasionally loses its mind completely. But we'll get there. The major venues where trading happens are stock exchanges. The New York Stock Exchange, the NYSE, is the largest in the world by market cap of listed companies. NASDAQ is the second largest American exchange, and where most major technology companies list. Apple, Microsoft, Amazon, Meta, Google. The UK has the London Stock Exchange, Tokyo, Hong Kong, Frankfurt. Each major financial center has its own exchange. When the exchanges close for the day, the price stops moving, which is why overnight news can create sharp gaps when trading resumes the next morning. To get a read on how the overall market is doing, rather than tracking thousands of individual stocks at once, we use indexes. A stock market index tracks a selected group of stocks and combines their performance into a single number that moves with the market. The Dow Jones Industrial Average, the Dow, is the oldest and most quoted American index. It tracks 30 large companies across various industries. When the news says the market was up 2% today, they usually mean the Dow. But 30 companies is a narrow sample, which is why most financial professionals pay closer attention to the S&P 500, which tracks 500 large American companies across every major sector and represents roughly 80% of total U.S. stock market value. The NASDAQ composite tracks all companies on NASDAQ and skews heavily toward technology, which is why it rises faster in tech booms and falls harder in tech crashes. In the UK, the equivalent is the FTSE 100. These indexes are not just scoreboards. They're the benchmark everything gets measured against, which leads to one of the most practically important questions in investing. If an index already tracks the whole market, why not just own the entire index instead of trying to pick individual winners? That question is why index funds exist. An index fund buys every stock in an index in proportion to its weighting, aiming to match the index performance rather than beat it. The fees are very low because there is no team of analysts making active decisions. You buy in, the fund holds everything, and you go up when the market goes up and down when it goes down. John Bogle founded Vanguard and championed this idea in the 1970s, and decades of evidence since have confirmed his central argument. Most actively managed funds underperform their benchmark index over long periods, and the ones that do outperform are largely doing so through luck rather than repeatable skill. Paying higher fees for active management that statistically underperforms the cheap passive option is one of the most common and most expensive mistakes regular investors make. Let's also talk briefly about bonds, because the stock market does not exist in a vacuum. Bonds are debt instruments. Companies and governments borrow money from investors by issuing bonds and promise to repay the principal plus interest over a fixed period. When interest rates rise, newly issued bonds pay higher yields, which makes existing bonds less attractive, so bond prices fall. Here is why that matters for stocks. When bonds are paying meaningful yields, investors have a real alternative to owning stocks. High interest rates make stocks comparatively less attractive, which is why stock markets often fall when central banks raise rates aggressively. The relationship between stock markets and bond markets runs through everything. You cannot fully understand one without the other, which is why every serious financial news story about equities eventually mentions what the bond market is doing in the same breath. Exchange-traded funds, ETFs, are a flexible version of index funds that trade on exchanges throughout the day like individual stocks. You can buy an ETF tracking the S&P 500, or the technology sector, or the bond market, or commodities. They've become one of the most popular investment vehicles in the world precisely because they offer instant diversification at very low cost. Now let's talk about valuation, because a stock price alone tells you almost nothing useful. What matters is whether the price makes sense relative to what the company is actually producing. The price-to-earnings ratio, or PE ratio, divides the share price by the company's annual earnings per share. A PE of 15 means you're paying $15 for every $1 of annual earnings. The historical average PE for the S&P 500 sits roughly between 15 and 20. A stock trading at a PE of 90 is either priced for explosive future growth or dangerously overvalued, and the difference between those two things is not always apparent until it's too late. That gap is the core challenge of investing, and the reason people with access to the same information consistently reach completely different conclusions. Value investing, the philosophy associated with Warren Buffett and his mentor Benjamin Graham, looks for companies trading below their intrinsic worth and holds them for the long term. Growth investing focuses on companies expanding revenues rapidly, even at the expense of current profitability, betting future earnings justify today's price. Neither approach consistently dominates across all market conditions. Both require a level of patience and tolerance for looking wrong in the short term that most retail investors discover they do not have, only after losing money finding out. Here is the piece most beginners don't fully account for. Markets are driven as much by psychology as by fundamentals. Two forces dominate: fear and greed. When prices are rising, greed takes over. Rising prices attract more buyers push prices higher, and eventually prices lose their connection to underlying business value entirely. Everyone is making money. Everyone knows someone making more money. Everyone is afraid of missing out. Then something changes, or nothing changes, and momentum simply runs out of buyers willing to pay current prices, and the fear cycle begins. Prices fall. Falling prices trigger panic selling. Panic selling drives prices lower. People who borrowed to invest face forced liquidations. Everyone who bought near the top realizes simultaneously what the word risk was actually pointing at all along. This cycle has a name: a bubble and a crash. It has repeated throughout financial history with a consistency that suggests humans are not getting better at recognizing bubbles from inside them. The Dutch tulip mania of 1637 is the textbook early example. Tulip bulb prices reached the equivalent of a skilled craftsman's annual salary for a single bulb before collapsing essentially overnight. The dot-com bubble of the late 1990s is the modern template. The internet was genuinely transformative, and the excitement was justified. But in the frenzy, companies with no revenue, no profits, and sometimes no coherent product reached billion-dollar valuations. The NASDAQ peaked in March 2000, then lost roughly 80% of its value over the following 2.5 years. Companies with .com in the name vanished. The technology was exactly as transformative as predicted. The valuations had no relationship to that fact. Then 2008. This one started not in the stock market, but in the housing market. Through the early 2000s, American house prices kept climbing, and banks kept lending to buyers, including many who realistically could not repay. These mortgages were bundled into securities called mortgage-backed securities and sold to investors globally. Rating agencies gave many of these securities their highest safety ratings, partly because their models assumed nationwide house prices could not fall simultaneously. That assumption was wrong. When prices began falling and defaults rose, the value of those securities collapsed. Banks holding them took catastrophic losses. Lehman Brothers, one of the largest investment banks in America, filed for bankruptcy in September 2008, the largest bankruptcy in American history at the time. Credit markets froze. The S&P 500 fell nearly 57% from its peak to its trough. The complexity went further. Those mortgage-backed securities were then sliced, rebundled, and repackaged into instruments called collateralized debt obligations, or CDOs. The riskiest slices of multiple mortgage-backed securities would be combined, and somehow this combination would receive a high safety rating because the models assumed the underlying mortgages would not all fail at once. When they did fail all at once, the CDOs collapsed, and anyone who had bought CDOs, thinking they were holding safe assets, discovered otherwise simultaneously. Pension funds, university endowments, and insurance companies around the world held these instruments. Ordinary people nowhere near the American housing market lost retirement savings they had never connected to anything called a CDO. That is how interconnected the global financial system had become, and how completely the failure of a core assumption about U.S. house prices rippled outward. The U.S. government responded with a $700 billion stabilization program, and the Federal Reserve cut interest rates to essentially zero. The financial system survived. Millions of ordinary people lost their homes, jobs, and savings, while many of the institutions most responsible were bailed out and eventually recovered. If you want to understand exactly how the crisis machinery worked, The Big Short explains credit default swaps through a Jenga tower and a woman in a bubble bath. It holds up. Now, GameStop, January 2021. GameStop is a chain of physical video game retail stores that was visibly struggling as gaming moved online. Its stock had been trading around $4. Several large hedge funds had taken substantial short positions against it, meaning they had borrowed shares, sold them at current prices, and were betting the price would fall further so they could buy the shares back cheaper and pocket the difference. Short selling is a legitimate strategy. It also creates a very specific structural vulnerability. Users on a subreddit called Wall Street Bets noticed that GameStop had an extremely high short interest, meaning a very large proportion of its available shares had been borrowed and sold short. They began buying aggressively and publicly. As the price rose, short sellers started bleeding. To limit losses, they needed to buy shares to close their positions. Those purchases pushed the price higher. Higher prices forced more short sellers to buy and cut losses. More buying pushed prices higher still. This self-reinforcing loop is called a short squeeze. GameStop's price went from around $20 to around $480 in a matter of days. Melvin Capital, one of the main hedge funds short the stock, lost approximately 50% of its value in January alone and required a multi-billion-dollar rescue from other investors. Part of what amplified the GameStop move beyond a normal short squeeze was the options market. Options are contracts that give buyers the right to purchase shares at a specific price by a specific date. As retail investors piled into GameStop call options, market makers who sold those options had to buy the underlying stock to hedge their exposure. That buying pushed the price up, which made the options more valuable, which attracted more options buyers, which forced more hedging purchases. This feedback loop between the options market and the stock price created a volatility spiral that nobody's model had fully accounted for. The term that went viral was gamma squeeze, and most of the people using it had learned what it meant approximately 48 hours earlier. Then Robinhood, the commission-free trading app used by most of the retail investors driving this, halted buying in GameStop and several other heavily shorted stocks. Users could sell their shares. They could not buy more. The price crashed immediately. The fury was instant and universal. The story that took hold was that Robinhood had stepped in to protect hedge funds from the retail investors beating them at their own game. Robinhood's actual explanation involved capital deposit obligations with clearinghouse intermediaries, which are real and legitimate constraints, but the timing and who happened to benefit made the explanation nearly impossible to land. Congressional hearings followed. The CEO of Robinhood testified, nothing structurally changed. GameStop stock eventually returned to levels near where it had started. What GameStop actually demonstrated was a set of things most people had not known existed, that short selling creates specific structural vulnerabilities that can be exploited by coordinated buying, that retail investors acting at scale can generate genuine market force, that the infrastructure between your trading app and the execution of your trade involves multiple intermediaries with their own obligations and interests, and that democratizing finance and actually redistributing power in financial markets are not the same project. One more concept worth understanding before the recap: market cycles. Stock markets do not just respond to individual company performance, they respond to the broader economic cycle. During economic expansions, corporate earnings tend to grow, consumer spending is strong, unemployment is low, and stock markets generally rise. During recessions, the opposite. The challenge is that markets are forward-looking. They try to price in expectations about the future, not just what is happening today. This means stock markets often start falling before a recession officially begins, and often start recovering before one officially ends. Trying to time your way in and out of the market based on economic news is therefore significantly harder than it sounds, because by the time the bad news is obvious to everyone, the market has usually already moved. This is what professionals mean when they say markets are efficient. Available information gets priced in fast, often before most retail investors have finished reading the headline.
So, a stock is ownership in a company.
The market is where that ownership changes hands continuously through price discovery. Indexes track baskets of stocks to represent overall market direction. Index funds let you own the whole market passively and cheaply, and decades of data suggest this beats most active strategies over long periods. The PE ratio is the starting point for whether a price makes sense. Psychology drives markets as much as fundamentals do. Bubbles form when momentum and fear of missing out replace analysis. 2008 showed what happens when the entire financial system builds on a false assumption. GameStop showed what happens when Reddit finds a structural vulnerability in a hedge fund's position and decides to drive a bus through it. None of this makes the stock market a scam or a guaranteed wealth machine. Over long periods, and for patient, diversified investors, it has historically generated meaningful real returns. Over short periods, it is capable of destroying significant amounts of money belonging to people who did not understand what they were participating in. The most boring and most reliable strategy in investing is also the most counterintuitive one. Buy a diversified low-cost index fund, contribute consistently, and hold for decades without checking it every day. It will never go viral. It will not make a compelling Reddit thread. It will, historically, outperform almost everything else available to ordinary investors over a long enough time horizon. The rent money stays for rent. The long-term money goes in the index. That is the whole plan. Hit like if this video cost you less than your last impulse trade.